Good morning and welcome to OETV. I'm Mehdi Sandaji and I'm joined by Jeffrey Huge from Alpha Insights. Jeff, welcome back.
Great to be here, Mehdi, as usual.
So we're here live at 9 a.m. on a cold, wet, windy, drizzly Tuesday morning, but things seem to be looking a bit better in the market. Last week was certainly volatile and it felt like we were going to continue on that downward path into Friday, but we had some rays of sunshine yesterday and it looks like we're looking pretty green today across the board as well. So, you published your monthly/quarterly piece on Sunday night. Obviously, lots potentially happened since Sunday night, but lots to get through. So let's dive in. Let's go.
Absolutely. So as you know, we've been articulating a pretty thorough bear case for some time now. I think in January of this year, we highlighted the potential that the market had peaked at least cycle degree in January, and potentially even super cycle degree. And as the data unfolded, as the market's price action unfolded, we became more and more confident in that view. And once we broke 4,300 to the downside, I think it sealed the fate for the market. And now we've gotten as low as around 3,600. But really importantly, we crossed into the path of what we've defined as intermediate wave 1 up of cycle wave 5 up, which was that big upside move off the March 2020 lows. And it peaked, I think, around September 1st or so in 2020. And that level was 35.88. We crossed through that level. Now, the way that we count the market is using the Elliott wave principle. And you can't, a fourth wave can't enter into the territory of the first wave. And so that's eliminated the possibility that this pullback is a correction. What it means is that this is the beginning of a motive wave of a new, larger degree correction that is going to correct at least cycle degree, possibly super cycle degree. And so we have a lot of confidence in that view at this point. And it's actually supported more by the number of nasty emails that we've received over the weekend telling us that we better rethink our view because we're going to get it wrong. That actually tells me that I'm on the right track. People are so anxious to buy this dip. All you hear about in the media is how bearish everybody is. And the reality is people aren't bearish. They can't wait to buy. In fact, look at all the analyst ratings, okay? Analysts have never been more bullish. There's about 1 sell rating to every 30 buy ratings. So, at the end of the day, we feel like the market is really setting itself up for a big leg down. And this rally that we had yesterday and the follow through today looks to us to be nothing more than a bear market rally at a very small degree of trend.
All right, so Jeff, let's dive right into your report. Obviously, you did the quarterly/monthly piece, which came out Sunday night. It's over 100 pages, and it's in depth on so many different asset classes, regions, sectors, just across the board. And we're going to start off with a slide that scares me every time we bring it up. But it seems like things are looking even more bleak than last couple of months when we've been referencing this slide. So talk us through this.
Well, it's really simple. We call this our liquidity risk model, and it's basically looking at a basket of highly rate-sensitive assets, basically cyclically sensitive assets, and rate proxies. So we're looking at a ratio of that. And, we've seen a breakdown. In fact, we saw the first breakdown in over a decade occurred in March, on March 31st. And we published this saying that, look, this model doesn't have a very, very long-term history. We actually developed it kind of back during the great financial crisis as a what if. What if we knew now what if we knew then what we know now? How could we have, anticipated this? And so, with the assistance of hindsight, we were able to kind of create a model that actually gave 2 really effective signals. The first one is it gave us a sell signal ahead of the financial crisis, and then it gave us a buy signal following the financial crisis. And so, it has been steadily up until March 31st of this year, when it cracked below that sell signal again, or that high risk signal, if you will. And the idea of a financial crisis means simply that there's stress in the credit markets, and we're already seeing it show up. We saw it show up in the UK a week ago, in their DB plans. These are $1 trillion of assets that are basically levered in fixed income securities with a bunch of variance swaps. And these are all things that kind of show up underneath the surface of the market indexes, right? Nobody knows who's swimming naked until the tide goes out. And what's happened is rising rates at a very short, in a very short duration of time, has exposed some of those risks. And I think there are more to come. We're already seeing it show up at Deutsche Bank and CS, although, many analysts are saying, oh, nothing to worry about, everything's fine. But I seem to remember them saying the exact same thing about Bear Stearns and Lehman Brothers before, utter collapse. And now the whole thing is, well, the regulators and the authorities know that, this is a problem, and they'll take the correct actions. They never take the correct actions. They're always late. They're always, it's a stimulus response for them. They're not going to head it off at the pass. And by the way, these aren't the only two banks that have serious problems. I think that, balance sheet issues in Europe are much broader than most people are willing to, commit to at this point. So, I think that this risk right here is significant. Another thing that it's not really indicating is how severe the volatility in the fixed income markets have become. I mean, the MOVE index got to 175. If you talk to Harley Bassman, he'll tell you anything over 150 is a crisis. So, we need to seriously consider what's going on in the credit markets and the implications. And this doesn't mean that the Fed's going to change their tune. They can't. They've got to quash inflation. They've got a completely different mission. And they've already said they're willing to accept some pain. There are going to be some casualties here. And I think investors need to sharpen their pencils and decide exactly what sort of risks they want to be exposed to. So that's basically the crux of this illustration.
And in regards to risk allocation, you were at 80-20 equities to bonds, and then several weeks ago you moved to more of a neutral 50-50 equities to bonds. Is there a point in the short term that you feel we're now going to go risk off and go 20-80?
That's a great question. So first of all, we went to 50-50 on June 30th. We got a trigger signal. It's a neutral signal, right? So we had been, more exposed to equities than bonds because, frankly, equities were outperforming bonds. Bonds have been one of the worst performing sectors in the major asset classes. And so, our thinking at this point is that 50-50 might simply say that the risks are now equal, okay, that stocks and bonds are going to go down together. I'm not so sure that a risk off, an 80-20, 20-80, 20% equities, 80% bonds is necessarily going to be a safer allocation than this, because at this point, it looks like stocks and bonds have the same amount of risk. So, we're looking at this really as a ratio of stocks to bonds, and it does not seem to be giving us a signal that there is a safe haven right now in the market. Both asset classes are down around 25% from peak to trough. And, that has not, served investors well to use bonds as a hedge. And so we're not sure that this is necessarily suggesting that by cutting back your allocation to equities, you're, creating a safer portfolio. It may simply be saying that the risks are equal now.
So we could almost slide into a 25-25 and stick 50 in cash.
We've been advocating maximum cash reserves, as you know, minimum equity exposure. And, as far as the 50 side to bonds, I mean, we would just simply allocate to the short end of the curve. Why not lock in 4% under 2 years? You haven't seen that in 15 years. All
right. Well, definitely a risk off kind of situation still. Jeff, we discussed this last week, but are we in a secular bear market?
I think so. It's a tough one to swallow, right? Nobody wants to hear this. But the reality is, if we look back over the last 90 years, we've been in something of a super cycle. This is a parallel trend channel off the 1929 high and the 1932 low, connecting to the 2000 high and now the 2022 high. And so that upper boundary has been challenged. And now we have to question whether or not we're going to retrench back into the lower boundary of this trend channel. And we don't necessarily have to touch it, but we can get close enough that it qualifies as a super cycle consolidation within that channel. And so, we've illustrated this in the most simplistic fashion we can, a three-wave corrective form of ABC, a zigzag. It is the simplest of the Elliott corrective waveforms. There are 11, including combinations, so it can get complicated. We're focused really on, what's happening in this initial leg down. How low can it go? And we do not believe that you can correct a 90-year advance in 9 months with a 25% correction. We think that this is going to get substantially more complicated for investors that aren't thinking about where we are at and what degree of trend we're correcting in this longer term cycle.
So that's a longer term cycle. Looking at the preferred Elliott wave count, has anything changed in your shorter term direction or some of the levels that we're going to expect to see?
The only thing that's changed is the breakdown into that 3588 low basically has now eliminated our alternative case. So we had been looking for something of maybe a deep lateral correction that over time, there's two sorts of ways that you can correct these big advances. You can do it in price or you can do it in time. And the alt really looked at this idea that, maybe we're just going to trace out a lateral consolidation over a number of years before we break out to new highs again. That is off the table with the breakdown through or below 3588. And so that occurred on Friday. And that gives us a lot of confidence that, even at cycle degree, we should be looking for a decline to at least the 618 retracement, which would be, basically truing up with the 200-month moving average and also a previous fourth wave extreme low. And that's typically where these corrections would carry. But, the way we've counted it, and if you look at the primary degree view on the right, you can see that the initial decline into the 200-week exponential moving average counts as 5 waves down. It's a leading diagonal, and the rally back into the 200-day moving average was a 3-wave corrective waveform. And so we've counted that as primary wave 1 down and primary wave 2 up. That suggests that the decline into the September 30th low is probably a minor wave 1 down. And that minor wave 1 down could very well just be experiencing a minor wave 2 bounce right now. We'd expect that bounce to carry really into around the 3,800 level. We could create a circumstance, based on prior experience and examples where we could trade as high as say 3,950. I don't think we'll get there. Around 3,800 is where I think that this bounce will top. And then I think we're going to roll over hard down. And that decline should basically be a third of a third wave decline, which is the most dramatic and powerful of the Elliott 5-wave motive wave progression. So, an impulsive decline into a low that probably comes into the range of around, say, 2,750 to 2,400. We'll call that primary wave 3 down. And we would expect a lateral consolidation, probably a triangle or a flat form to follow that will fall short of the primary wave 1 decline in terms of its rally back. It'll probably be less steep in terms of its magnitude, than the second wave decline because of the alternation that Elliott's thesis has. And so, we expect something more in the lateral manner. And then we expect a final plunge down to around that 618 retracement level at 2250, which again coincides with a prior fourth wave low in the 200-month moving average. We think that should be the end of cycle wave A, which again should prove to be a motive wave, 5 waves down. Once we get that first cycle wave A termination at 2250, we would expect it to be followed by a corrective bounce, which could retrace upwards of 50% of the decline. So we'll call that cycle wave B when it terminates. And, that's probably going to be a very tradable rally. And we think it could be at some point, we'll find the bottom in Q1 23. And this could carry us into, say, summer highs in 2023.
So, being the ever optimist, if we're in this bear market rally right now, you say, 3,800 is likely the top, 3,950 would be a surprise, but potential top.
I wouldn't say it's a surprise. It's an alternate.
Okay. And at what point would you rethink this thesis? Would you say it sustains, close above 3,950?
I think if we were able to take out the August 16th high, so 43.26 or higher, would be my make or break on this count. And it would cause me to kind of rethink where we're at. I don't believe that we would be headed for a new bull market, but it could just be a more complex corrective waveform. And so we would have to dig into our toolbox to determine what that is.
Understood. Let's have a look at market participation. It looks like this is continuing to narrow.
Last month we showed that U.S. stocks really were, about 25% of all U.S. stocks were trading above their 200-day moving average. As of the end of September, that number got down to 15% of all U.S. stocks are trading above their 200-day moving average, meaning that 85% are trading below. That is very narrow participation. And frankly, when we look at the number of new highs relative to the number of new lows, there's really nothing to talk about. I mean, the number of new lows continues to expand month after month. And I know a lot of people got very, very excited last week when we saw fewer new lows on Friday than we saw on Monday. And that obviously is a setup for a nice little bounce here that we're seeing at the beginning of this week, but I do not believe that is going to carry substantially higher. In fact, this, in my view, is nothing more than a minor wave 2 bounce, and we should see it terminate here in the not too distant future.
Well, you mentioned it, but cumulative net new highs, it does feel like we're breaking this upward trend.
Yeah, so, on the NASDAQ, we broke below kind of the initial support level and, subsequently took out trend support. Now we've taken out, critical chart support, and, it's in a hard down move at this point. New York Stock Exchange cumulative net new highs have been a little bit stickier, but you've got to consider the fact that, NYSE listed issues include a lot of bond proxies. And so they're falling at a slower rate of change, preferred stocks, things of this nature. And so we're not seeing the same impact as we are a lot of the, formerly sexy growth stories that have, imploded that are driving NASDAQ lows. And so the breakdown initially below what was trend resistance or trend support rather, and now chart support, initial chart support, suggests that we should see cumulative net new highs in the New York listed market as well start to follow what we've already seen in the NASDAQ.
It also looks like the cumulative advanced decline lines are telling a similar story.
I concur, yes. We made a new 52-week low on both the NASDAQ and the NYSE cumulative advanced decline lines last month. And, that suggests that it is confirming the lows in price. Normally what you would see preceding a reversal would be a positive divergence. In other words, breadth would close at a higher low as price makes a lower low. And that positive divergence would be indicative of a slowing in the momentum and the breadth of the decline. Typically, that would precede a durable rally. So we did not see that. In fact, we saw confirming evidence in these broad measures of participation that most stocks are declining with the price in the index.
And it certainly looks like volatility is on the rise.
Yes, I concur. We've kind of indicated in the past that 24% has been the boiling point in the past for volatility spikes. And also when we move above the 55-week moving average, we can also have some confidence that the trend is reversing to the upside. And both of those factors have come into play now with respect to the VIX. We see, a larger degree pattern forming here, a series of higher lows and followed by a series of higher highs. And, since we saw that big spike in 2020, April of 2020, when the VIX spiked at its last time, we've seen that kind of reverse down to that prior uptrend, that longer term uptrend that dates back to maybe 2017. And what we're seeing now is things bouncing off of that kind of low range that came into near connection with that uptrend. And I think what we're poised to see now is a move upwards of 30%. We saw initially a move there last week. We've pulled back somewhat this week, but I think longer term we can expect to see the VIX move above 40%, possibly 50% in the weeks immediately ahead.
How's margin debt looking? And what's this also implying to us?
Well, we're really focused on the rate of change with margin debt, but in absolute terms, we did see margin debt decline in August. And understand, again, this is reported by FINRA about 30 days in arrears. So we get kind of a delayed indication here. But, we're down, something like 26, 27% from the all-time high, which is about a year ago. Margin debt was $935 billion. It's now about $688 billion. But the rate of change peaked in March of 2021 at about 71%. It's now negative 25%. So that is utterly collapsed. But what's really important is that past large degree bear market lows, such as that which we saw in 2002 and also 2009, occurred when the rate of change reached negative 40 to 50%. So we still have a ways to go in terms of the rapidity of that decline. In other words, that rate of change, the momentum of the decline, if you will, it can still go lower, and we expect it to go considerably lower before we see a low in stocks.
Okay, so we've definitely got some room before it gets even uglier here. Looking at economic growth, we touched on this last week in regards to the implications towards being in a recession. Do you feel we are in a recession? How are we looking at the economic growth dashboard?
I think it's debatable. Obviously, economic growth collapsed in the first half of the year. We saw 2 consecutive quarters of contracting real economic output. And that historically had been consistent with every recession for the past 50 years. Now, the NBER will have to call this. They always call it after the fact. And so we won't know officially, quote unquote, probably for many, many months when, in fact, the recession started, if it did start, and if we are in a recession today. What's interesting is that the third quarter is shaping up to be positive. And it had been about, say, a month ago, tracking to about 2.6% growth. It ticked down to about 0.3. And then last week, it ticked back up to about 2.4. I think yesterday, it's actually ticked down slightly, maybe 2.3%. There's a lot of time left in the quarter. We're going to continue to get readings for the next month. And so by the time third quarter GDP is reported, my suspicion is it's going to be lower than the 2.3, 2.4 that the Atlanta Fed's GDP Nowcast is currently modeling. The real question is, will it go negative? And I think if it does, then it's confirming what I think most people already know, is that we're in some form of a mild recession already, if not rolling recession. It's showing up in a variety of areas of the economy: housing, autos now, and consumer. CarMax reported dismal results, and their management basically said, well, people can't afford to buy used cars anymore, and it's not because of the price; it's they can't afford the payment because interest rates have gone up. And so we've kind of gotten into that situation where consumers' disposable income is stretched to the max at this point. I don't think that's going to change anytime soon. We've also seen, this issue with stuffing of the channel, these inventory builds. Nike's quarter was another one. And we're starting to see a slowdown in delivered goods. FedEx reported that. And so all these things together start to give us all the anecdotal evidence that points to at least a rolling recession. It'll be interesting to see if we do see a big spike up in real economic output in the 2+% growth area, then I think that would indicate that the Fed's rate hikes are starting to have an impact on inflation. And that, I think, would be something that we would be happy to see.
Now, let's talk Fed. Obviously, there was almost a consensus on 75 basis points in the November meeting. Do you think that stays at 75, or do you think we could tick down to 50?
It's a good question. We've seen the CME Group's FedWatch tool, kind of handicapping this. We had a 70% probability just a couple of weeks ago of a 75 basis point hike. I think that's come down to about a 50-50, looking at a 50 basis point to 75 basis point hike. The Fed's come out and basically said that they are going to raise rates 125 basis points between now and year end. I think the issue is what increments they deliver that in. Is it a 50 and a 25, or is it a 75 and a 25 and a 25? It doesn't really matter because by year end, we're going to be at around 4.25 or so on the Fed funds rate, and maybe 4.50. The Fed has come out and said that they see a terminal rate in the 4.5 to 4.75 range, and that is pretty much where the market is pricing in. The street's a little bit below that; they're at 4.25. But nevertheless, I think we're going to be north of 4% by year end on the Fed funds rate, and the real issue is what breaks first. Is it the economy? Is it the stock market? Or is it the bond market? We already know housing is bending. Maybe housing will break, but they just haven't built enough houses out there to fill the demand. And so I think housing will remain more stable. But we've seen a dramatic slowdown. I think it's more likely we're going to see the bond market break, and probably the stock market with it.
Let's have a look at the yield curve. There's been a lot of focus on this. Where do you feel we go with yield curves?
Well, I think eventually we're going to get an inversion between the 3-month T-bill and the 10-year Treasury yield. That's still positive at this point, to the tune of around, I think, maybe 39 basis points or so as of last time I looked. But what's interesting is the 2s, 10s has been inverted for some time now, and it's a fairly significant inversion, somewhere in the neighborhood of around 40 basis points or so. And I think that the 2s, 30s north of 40 basis point inversion as well. It's a stone cold fact that the yield curve is the best predictor of the economy going forward. Each time we've inverted on a 2-10 basis, looking back over the last 5 recessions, it's preceded a recession. Usually the recession comes following that peak inversion and as we begin to steepen. So as soon as the yield curve begins to steepen again, we should be worried that that the economy is in recession. And we've already started to see that steepening on the very, very short end, that 3-month to 10-year range. That has yet to invert, but I think focused more on the 2s, 10s at this point. Once that inversion begins to steepen significantly back into positive territory, that will probably be the signal that the economy is truly in recession.
Jeff, this is also your quarterly piece. You did a deep dive on sectors. Are there any sectors that you'd like to discuss that are worthy of note going into this final quarter?
Yeah, this is a monthly rotation model. So we've graduated from a weekly to a monthly to try and look more at sustained leadership as opposed to shorter term leadership. And so, what we're doing is we're looking at relative strength trends, both the relative strength ratio and the momentum of that relative strength ratio in this rotation. And the rankings continue to favor kind of these same sectors that have been in play for some time now. Energy continues to be the leader, albeit it had a very tough month of September and third quarter, to be sure, right? Utilities, staples, healthcare, also these really defensive sectors continue to be in leadership from a relative rotation perspective. The flip side of that is financials, technology, discretionary, and comm services continue to be big laggards. What's interesting to us is that discretionary, which is the second worst performer, actually has not made a new low. In other words, it hasn't taken out its June low at this point. It continues to ride along that structural uptrend that's been in place for the last 13 years. And so, this actually is a ray of hope, right? One of the reasons I think that discretionary has held out is because two of the largest components in discretionary are Amazon and Tesla. And those two stocks, despite the fact that they've been down substantially, are holding up better than most of the other names within the discretionary space. And so Tesla in particular had been holding up substantially better than most of the FANG names. And in fact, it wasn't until Elon Musk released the delivery data over the weekend that we saw a big divergence between the performance of the discretionary sector and the NASDAQ at large and that of Tesla. Tesla shares were down 8.6% yesterday, while the NASDAQ was up, I think, 2.4% roughly. So, there was a huge disparity in performance, and a lot of that was reaction to a data point, but it doesn't change the fact that there's a non-confirmation of really the most important bellwether name within the discretionary space, that being Tesla. And we've been big believers that as goes Tesla, so goes the NASDAQ. So let's beware of the weakness in Tesla because I think it's a harbinger of what we should expect out of the NASDAQ going forward.
So Jeff, I know we're getting tight on time here, but I just want to touch briefly on foreign markets. You do look at these, foreign markets outside of the US, which is primarily your focus. Anything of note here?
I would note that China was the worst performer last month and Brazil was the best performer. Brazil continues to rank highest on our relative strength model. China actually ticked up. We saw improvement in the rotation model despite its horrific performance last month. And so it's out of the bottom 5. So in other words, it's a market weight now. And we had been underweight China last month. So it was, timely. But now Taiwan has fallen into that space. Taiwan was the second worst performer. It now looks like Taiwan could continue to be an underperformer, as should Italy, Netherlands, Germany, and South Korea. Accompanying Brazil on the overweight side would be India. And then some of the Anglo names, Canada, UK, and Australia continue to hold up better than the rest on a relative strength basis. That doesn't mean that they can't go down on an absolute basis. We're just talking about relative strength here.
Understood. And macro asset leadership, I have to specifically ask you about one that everyone keeps questioning. What's going to happen with the dollar?
Yeah, we're big dollar bulls. And, we put up a chart, of course, suggesting that the dollar has more upside. And we're just simply using a basic technical measure known as a measured move. And we're looking at a range consolidation that took place over a number of years that broke out earlier this year. And that breakout counts to about 121 on the dollar, a little less than that. And so we're putting out a target of 120. We had previously had a 115 target, and 120 was our stretch. We didn't advertise that. We hit the 115 more or less last month. And so we're going out with our stretch target. You know, there's certainly the potential for some consolidation here, but these measured moves tend to bear out over time, and the momentum supports it, both relatively and also on an absolute basis. So we continue to be bullish on the dollar, and we expect dollar assets to outperform non-dollar assets.
All right, Jeff, we've covered the whole world, every asset class, every sector. How do we make some money here?
It's a good question. We do have a name that stands out on the bullish side that we'd like to highlight in biotech, and that name is Regeneron Pharmaceutical. A beautiful, classic pattern-based formation of the cup and handle variety has been developing in the shares of Regeneron. We've got a recent breakout above, initial resistance, and we're hoping for a follow-through above 140. Stock went out about 135 last night. I think if we can carry through that, I'm saying 740, not 140. Went out at 735 last night. The breakout above 740 looks like it could carry up a couple hundred handles. We've got a target of 940, and this 2-year base looks like it's got a lot of durability to it. So unless the stock were to come back and close below 680, we'd want to stay long Regeneron here. That stop loss at 680 gives us about a 3-to-1 positive risk skew to our 940 target.
It's a good looking chart. What about on the short side?
On the short side, none stands out more to us than Qualcomm at this point. Qualcomm's broken its long-term uptrend. It's put in a very large degree classic pattern top formation of the head and shoulders variety. And in fact, the breakdown below about 120 confirms that the stock is already heading for our initial downside target of $85. So the stock closed yesterday at about 117. I think in the pre-market, I saw that it was challenging that 120 again. I wouldn't worry about it. Once we've already come through the 120 level, I think we can expect it to follow through. Unless the stock backs up above 129, I'd want to stay short on Qualcomm. Longer term, I think the stock has downside to $50. If it hits our $50 target, that would translate into an 8-to-1 positive risk skew on the short side. Keep in mind, this is a 2-year structural top formation. So it has a very powerful downside potential.
Understood. Looking at that very scary chart. Jeff, thank you so much for your thoughts today. And there was so much to unpack. We get through these things as we can.
Always a pleasure.
And for our viewers, I just want to urge you to subscribe to Alpha Insights. We barely touched on anything in that report, the quarterly report. We went through about 20-25 slides here today. There's well over 100 charts and some deep conversations on across the board, asset classes, countries, sectors, anything you want. So I would urge you to check out Alpha Insights. Everyone watching, thank you for watching and good luck investing.